Good afternoon, everyone. Welcome to Eleving Group 6 months 2025 earnings call. We will start with company's presentation, followed by a live Q&A session. We are looking forward to receiving your questions. You can either submit them in writing through the Q&A window or raise your hand and be unmuted after the presentation is over. For your convenience, we are recording this session, and replay will be available shortly after the call. That being said, I'm turning the call over to our hosts, Eleving Group CEO Modestas Suņas and CFO Māris Kreits. The floor is yours.
Thank you very much. Good day, everyone. First of all, welcome everyone for joining Eleving earnings call for first 6 months of 2025. So my name is Modestas Suņas. I'm the CEO of Eleving Group. Alongside me, we also have our CFO, Māris Kreits. And today, traditionally, we're going to go through the latest company results. And not only that, we'll look into the recent operational developments, business developments, as well as look at the share price. And basically, we'll cover all the latest company news. Before jumping into the presentation, maybe a quick intro of what to expect today. Overall, for the company, first 6 months have been very successful from operational perspective. We've reached many milestones and already see good traction of projects which we launched in first quarter. We see that very nicely developing in the second quarter. However, also we need to admit that on some KPIs we're slightly lagging behind. We'll also touch upon that. So now I suggest to start with slide number 4, which is group performance, where we'll touch upon 2 main KPIs, net portfolio and net profit. Let's start with net portfolio development. As you can see from the slide, in the first 6 months of the year, our net loan portfolio has grown from 371 million to 375 million. So just a slight growth, slightly below to what was expected for the year. If we deep dive into the reasons for that, then we need to look at the right hand of status bars, where we see how the growth would look if we would look at constant currency rates. And here we already see that the growth rate is way higher. The portfolio would stand at 391 million euros. So with this graph, we want to address how the macroeconomic situation in the world with a little bit uncertain US tariff rates have affected our business indirectly, because US dollar has lost quite a lot of value, actually 13% in first 6 of a month, so quite unprecedented movement versus euro. And that had some effect to some of our currencies because frontier market currencies tend to follow dollar movement. So that's what we see from net loan portfolio development. But that being said, us having rather effective hedging instrument in place allowed us to have to absorb it in P&L quite successfully, and that we can see in the net profit results. If we would look at first 6 months of this year, so our net profit before forex effect was close to 21 million, 20,900,000, which is significantly above last year result, which was at 17 million. And also, if we would look post forex fluctuation results, they were better than the last year and stood at 15.2 million euros. Overall, here we're well on track to reach profitability estimations for the year. If we look at before forex effect, as our estimations were slightly above 40 million, and we're already halfway there. Also worth to mention another positive news is that we have won the appeal against the Romanian tax authority, which I guess we've in last quarter of last year, we've announced that we had to pay 3.4 million euros of VAT liability. So the appeal was successful, and then that's very positive, good positive news for the Romanian market. And it just once again proves that the company is able to find a productive dialogue with local authorities. Now let's move to next slide. Let's take a look a little bit more into the growth achievements. Let's start with sales. So first of all, a milestone of 100 million euros per quarter issuances have been reached. In first 6 months, we have issued 200 million euros worth of loans, which is a big leap compared to the same period last year, almost 20%. And two main reasons for that. So one is that demand for our product is stable and actually growing. That can be seen in number of applications received, which exceeded 1 million of applications first time. And another reason is that we're offering customers more and more better tailored products to their needs in our existing markets. This way to adjusting to customer needs. And that we can see in the product segment. Some of you may recall that in the first quarter of this year, we have launched consumer loan products in our existing vehicle finance markets, three of those markets, which is Latvia, Romania, and Estonia. And already we see some nice traction. The core focus for now is to offer these products to existing customer database, so to do upsells, customer retention. And we already see tangible results in second quarter, just in these three markets, 7 million euros worth of loans have been issued. So we plan to continue the strategy going forward to further scale this product in these three new markets, and as well as most likely add additional markets in the nearest quarters. So those could be Lithuania, Armenia. Another exciting development is our smartphone financing product, which we launched just at the first part of second quarter in Uganda. So already in first quarter, we managed to finance more than 7,000 smartphones, which is a very encouraging result, especially taking into account the project still is in a pilot phase. And here our focus is mainly our existing motorcycle taxi driver database, which actually allows these motorcycle drivers to improve their unit economics, because they can start using ride-hailing apps to generate revenue as well. And as well, a very quickly growing dealer network, which we already have more than 500 onboarded. And the first results, what we see from risk factors and similar metrics are also very encouraging. So following that, we also launched in June a similar pilot project in Kenya. So we'll be tracking the results, and then we see actually that this could be a very nice additional revenue stream for Kenya and Uganda markets. And maybe just as a reminder that every phone which we finance, it has a proprietary Eleving app installed, and which allows us not only to inform customer about upcoming payments, to actually initiate the payments, but also in case of customer non-payment, this app can block part or even full smartphone function. So it's really tech-driven product. And lastly, talking about expansion, so our plans to launch 1 to 2 new markets this year have not changed. We already have good traction, and we believe that already in third quarter we'll not only announce which market has received the license, but also we'll announce that the new loans started being issued in that market. So we'll keep posted everyone on that. So summing up, you see that a lot of new developments have been initiated in first quarter and second quarter, and in the remaining 6 months of the year, we should see sizable contribution to our net loan portfolio revenue and profitability coming from these new products, because all of them are launched on the existing, I would say, existing cost base, existing infrastructure. With that, let's move to the next slide, slide number 6, our traditional slide. So global footprint. Let's start from the pie chart on the left, where we can see how our portfolio is being split between different products. Here, I would say not many changes, very similar split in place to the previous quarter. So consumer finance, non-collateralized products are 1/3 of our overall net loan portfolio, and 2/3 are split between secured products, whether it's a traditional vehicle finance or flexible and subscription-based products. When it comes to vehicle finance markets, again, very equal, very well diversified kind of split between the markets with no very significant deviations. Probably, if I would need to mention markets with the biggest growth in second quarter, that would be Latvia, especially including the Primero brand. And just a reminder, Primero brand it's a joint venture with a local bank. So at the end of second quarter, net loan portfolio stands at close to 48 million euros, and a very similar portfolio with a very nice growth throughout all this year is in Romania, also at 48 million euros. On consumer finance side, worth to mention two markets with the biggest growth in terms of additional new loan portfolio added. This would be Botswana, which actually first time overtook North Macedonia and now is almost at 22 million euros of net loan portfolio, and Namibia, which is also approaching 15 million euros. But of course, here the market which traditionally stands out the most is Albania, where we have close to 40 million euros of net loan portfolio. So combination of that, all these markets, you can see that the risk split between the portfolios is quite well diversified across product lines and then in different markets. Now let's turn to the slide number 7, non-financial KPIs. Let's start from the right side, applications received. So first time in one quarter, we received more than 500,000 of applications, and throughout first half of the year, as already mentioned, above 1 million applications. We see still big growth in applications received for vehicle financing products, so more than 13% growth. And also we saw a slight decline in applications received on consumer finance product, almost 7%. This is mainly can be explained by our own strategy implemented in Balkan markets, where we really put majority of our marketing efforts into customer retention. That means working with our own database and cut down some of the most expensive kind of marketing activities to attract new customers, such as TV, because we do see that the traction and work with our existing portfolio is enough to kind of sustain reasonable growth rates. When it comes to conversion rates for both products, nothing new here, quite stable rates. They've been for vehicle finance part, we've been fluctuating between 8 and 9% lately, and similar stations in consumer finance, where we're at around 32-33%. But most importantly, when it comes to unit-wise vehicles financed and then the consumer loans issued, still growth has been observed in both product lines. Of course, in vehicle finance, it's way more significant, but on the consumer finance side, even though it's kind of almost flat, but the average size of the tickets are growing quarter over quarter. So with that, I'd like to finish this part of the presentation, and now turning to our CFO, Maris Preits, to walk you through financial highlights.
Thank you, and hello everyone on the call. It's also my pleasure to be here with you today and present financials. So starting off with slide 8, financial highlights. Let's kick it off with the revenue. So for the first 6 months of this year, we managed to achieve 117.5 million euros in total revenue, which is slightly more than 10% increase if we compare it to the same period in year 2024. And if you look specifically on the revenue generating lines, so our subscription and flexible products, together with the consumer financing products, of both, each of them increased by more than 10%, so 17 and 11% respectively. And the traditional finance product segment has increased its revenue by close to 6%. So there's nice growth in total top line across all the major revenue generating streams. If you look now at the EBITDA, adjusted EBITDA in our specific case, so for the first 6 months of this year, we're looking at 45.3 million euros, which is close to 4% higher figure than it was achieved for the first 6 months of the year 2024. Here, you'll notice the disconnect. So our EBITDA has grown at a slightly lower rate than our top line. Essentially, this is not unusual, especially in a case where, like ours, where we are building up operations for new products, new market launches, as well as trying to increase the loan portfolio. So this naturally comes with slightly upfront based expenses, general operating expenses, as well as impairment expenses. Again, this is not unusual, and we feel like this is in good control as of this moment. Now, if we look at the equity development for the first 6 months of this year, naturally, we see that we have added 14.5 million euros as a means of total net profit. In addition to that, you'll notice dividend payment. So during the month of June of this year, we made 15 million euro dividend payment for the full previous year. And that was actually first dividend payout for us being a publicly listed entity after IPO. You'll notice also a slight difference between 80.2 million euros and 15 million euros that were distributed to our shareholders. The difference essentially is the fact that we need to upstream the dividend payouts from our subsidiaries, operational subsidiaries, up to the Luxembourg level. And once we do that, there's also certain payments made to minority shareholders. Speaking on that, we have also made a strategic capital allocation decision. We have repurchased part of minority shares. So with doing that, we are actually making sure that there's more future profits left for the majority shareholders, mainly, meaning all of the Luxembourg shareholders, including public shareholders. And lastly, the Forex translation reserve. So this was a negative impact. This is the Forex impact that is being accounted within the equity directly. And you'll find that in the other comprehensive income. So on the Forex movement in general, as explained previously by Modestas, we faced basically headwinds in terms of Euro USD currency pair movements, quite unprecedented. But nevertheless, with that, we can see how our business model and our financial results show that we are able to absorb that. So all in all, our equity as of end of June compared to the equity as of the beginning of the year has decreased slightly. But again, it's worth to mention that the majority of this equity decrease actually went for the benefit of our shareholders. Nevertheless, our equity to total assets ratio remains to be high. It was 20.1% as of end of June of this year. Simultaneously, our return on equity ratio remains to be above 30%, specifically 31.6% for the first 6 months of this year, which is largely in line with our historical averages. If you compare that to the first 6 months of year 2024, you'll notice a slight decrease. This is normal, as for the first 6 months of 2024, that result does not take into account any IPO proceeds. We did an IPO in October of last year, so that's why it's natural that for the return on equity to decrease immediately post-IPO in the short term. And lastly, on the cost-to-income ratio, we're pleased to see that we are at 36.3% for the first 6 months of this year. But here we need to also, of course, admit that there's a positive tailwind, and that comes in a form of Romanian VAT case, which we successfully won in the appeal. As of this moment, the money is returned into our tax accounts, and we're working together with the tax authority to make the final step, which would actually mean the cash to be received in the bank accounts as well. So we are getting there. Now let's move to the next slide, please. So in this slide, we have our interest-bearing liabilities breakdown. Without any surprises, almost 2/3 of our interest-bearing liabilities would be concentrated into our issued Eurobonds. So 150 million Eurobond, which is maturing in year 2026, and 90 million Eurobond, which is maturing in year 2028. We as a company were especially pleased to see where these bonds are trading in secondary markets. So notably, both bonds have yields to maturity below 10%. So somewhere in between 9.8 and 9.9%. And this is a nice development. And here, actually, it is worth to link it also with the developments on the Mintos platform. So currently, we have more than 50 million euros attracted funds through Mintos platform, and we are attracting funds in the platform currently at 8.8%. So all taken together, we can take it as a good proxy where the market currently assesses Eleving's cost of credit, so in a range of 8 to 9%. So this positive development, together also with the positive news from our Fitch Ratings agency, where we had recently improved rating from B with a stable outlook to B with a positive outlook, and also together with a very stable financial situation, which you can see on the lower part of the slide in terms of our financial covenants. As you can see there, in almost every single covenant, we're almost 2 times at a better level than that we need to maintain at any given moment. So all this taken together puts us in a quite comfortable position to start assessing a potential 150 million euro bond refinance that might happen sometime during this year. So as of this moment, we have started preparatory works in terms of legal assignments, as well as discussions with our potential partners, banks, brokers, also market players sounding. So all this has been commenced basically, and we are all now we're in preparatory phase to assess the refinance opportunity, which might happen sometime during the fourth quarter of this year. More, of course, information will follow in the next few months. In addition to the bonds, also and Mintos, it's worth to mention our very successful local fundraising activities. So as of this moment, we have slightly more than 50 million euros attracted through local sources in our subsidiaries, and most importantly, in local currencies. So this is a vital source of financing for us and very important because this helps to mitigate the open foreign currency position for our business. And in addition to that, we also have already a 15 million euro pipeline for potential deals that we expect to close in the upcoming few weeks, maybe a month. Now let's turn to the next slide, please. So in this slide, we're looking at our portfolio quality. Our portfolio quality remains to be strong. If you look at our vehicle business segment and the net loan portfolio breakdown there, we can see that NPLs are at 5.5% with a 35 days overdue definition. And on a consumer business segment, our NPLs are at 4.4% with a 90+ days overdue definition. On the right-hand side of the slide, you can see our gross before provisions and net after provisions NPLs development over the last 4 years. You can see how starting year 2022, we are no longer showing the NPLs within our Ukrainian portfolio, which we had at the time. Actually, while we are on this topic, it's worth to mention that during this quarter, we have fully sold all the assets and legal entity of our Ukrainian business, and we no longer have any exposure there. Moving on to the next slide. So here in this slide, we have a bit more details about our share price and share performance. So our share has been trading relatively stable at or slightly below IPO price. So as of the end of July, share price was at 1.65 euros per share in the most liquid market, which is Nasdaq Baltics for our share. Our share is also being traded in Frankfurt. That share price is 1.7. But if you come back and if you look at the Nasdaq share price, which is 1.65 euros per share, I believe as of this moment it already has improved 1.68. But that still, of course, is a slight decrease when we compare to IPO price, up to 3%. However, it is very important, and this is what we would like to highlight here, is also a year-to-date dividend yield, which is 7.5%. This is something which we managed to pay to our shareholders in the form of dividend. As mentioned before, 15 million euros paid in the month of June. So all in all, our shareholders have made money by investing in our share, and there is still positive total return for our shareholders. And here, the important aspect is that this dividend yield for the year still does not account the future dividend, which we plan to distribute in November, also this year. The specific amounts will follow sometime as of end of September, beginning of October. But all that is expected to improve the total return for our shareholders and increase the dividend yield of our share. And lastly, as per analysts covering our share, we can see that they have not changed their target price levels. And as per their assessments, our share remains to be substantially undervalued compared to their calculation of the share fair value. This would be from my side. I'll turn back to Modestas now.
Thank you, Marius. So last slide of today's presentation, business outlook and then financial KPIs. Maybe before jumping into that, a bit of a summary. What do we see from first 6 months of this year? So as already presented across multiple operational KPIs, it was a very successful first 6 months, and even despite some slightly higher than expected forex volatility headwinds, still even on profitability level, it was a strong half a year for the business, and then we managed to absorb all the bumps, and to top that, all the developments which have been done so far up to date, they will be contributing to overall growth of the business and profitability of the business in upcoming 6 months as well. And this is a good transition, I believe, to business outlook. So probably repeating myself, when it comes to products and markets, core focus for this year is utilizing our existing customer base, our existing infrastructure, and focusing on organic growth first and foremost, as well as launching new products such as mobile phone financing, smartphone financing in some markets, consumer financing in vehicle financing markets, as well as increasing existing customer exposure. So all of that remains the biggest emphasis for the business and then the biggest source of growth. But nonetheless, as already mentioned, we do plan to launch at least one new market this year. When it comes to capital management, I guess Marius very well mentioned that absolutely top priority is our 2026 bond refinancing, and then most likely even raising more money. And we're already in preparatory stage with goal to refinance the bond well in advance to its maturity. And lastly, if we look at the financial KPIs, so just as a reminder, these are all publicly kind of shared financial KPIs at the beginning of the year. So if we look at net portfolio development in mid-year, we're at 375 million. So we're still quite a gap to the target of 432 million euros. Reasons we've already discussed, but we do believe and anticipate that this gap until the actual target will become way smaller or even fully covered in upcoming six quarters, and similar stations with revenue, which portfolio is the main source of revenue, and currently we stand at 116 million, and our overall target is slightly 263 million euros. So we might be slightly below that target at the end of the day, but we do see that revenue is growing on a monthly basis, and the gap should be breached, and the gap should be decreased. But what's important that on net profit for Forex, we're actually doing very well. We're well on track. 21 million euros at the mid-year, so very close to, basically we're midway to the 44 million target. So with that, stopping here and now turning back to the operator for Q&A session.
Thank you for the presentation. We are now opening the floor for questions. Just a reminder that please submit them in writing through the Q&A window or raise your hand to be unmuted. We will start with the questions submitted prior to the call, then prioritize the audio questions, and then continue with those submitted in the writing. So first question, is there any update on the refinancing of the 2026 bond or issuance of new bond?
Yeah, so thank you for the question. I believe we already at least 2 times mentioned the developments there. So yes, we are assessing the possibility to refinance 2026 bond. And if the transaction will come to the market, it most likely will happen during the closer to end of the year, most likely sometime during the 4th quarter. As of this moment, this is all we can disclose publicly.
Thank you. Next question, do you plan to introduce any stock buybacks?
Yeah, when it comes to public stock, so far we don't have such plans. We just had not so long time ago an IPO, so basically it's not in our strategy, but we do selectively buy back some of the minority shareholders on a below Luxembourg level entities, which essentially improves the return of Luxembourg shareholders. So that will stay in place.
Thank you. Have you prolonged the time when the largest stakeholders can sell their shares?
No, but actually the largest shareholders already had rather say restrictive non-sale clauses, and they cannot sell their shares first 2 years after IPO, so still more than one year left, so no changes here.
Are you still paying dividends, and when will the next dividend payment be made?
Thank you for the question. So interesting question. If we just one month after the previous dividend payout, or slightly more than that. So yes, we're paying dividends. So last dividend payout did happen in the month of June. We anticipate to have next one in November. And yeah, on the specific amounts, please do wait for the more details that will be announced during end of September, beginning of October.
Thank you. The next question, do you plan to lend out internal cash, or is lowering interest rates on bonds the long-term goal? Mix of both and benefits.
So our business basically is lending out cash as much as possible. So ideally, we would have zero cash on the balance sheet. Unfortunately, that's impossible. So the cash that we have currently in the balance sheet in the range of, let's say, 20 to 30 million euros, given our total balance sheet of close to 500 million euros, is quite optimal. If not on a lower side, I would say. So this cash level allows us effectively to service our debt, service our liability commitments, and ensure the growth of our loan portfolio. we expect that to remain this way. So all in all, the cash you see right now are in the balance sheet would be for operational purposes, but of course we're lending out to our customers as much as possible.
Thank you. Impairment expense grew significantly above loan portfolio. Is it due to cell phone financing, and can we expect such level onwards?
So the increase in impairment in the absolute terms is not related to cell phone financing. Cell phone financing, although in unit terms looks quite impressive, in the euro terms it's still growing, and it's still not too material for our total business. So the increase in the impairment expenses is actually in this quarter relates mainly to our consumer lending business, and specifically a few market specifics in the Balkan region. We see that we are able to not sell bad loans at the same level as we were used to be selling it before in terms of amounts and prices. So we need to kind of tweak our debt collection capabilities and service more debt in-house. And also we have also different, let's say, temporarily challenges, especially in our African markets, while we're still tweaking our customer service and debt collection strategies in order to service the debt. So this is not the level we would see going forward. This is, I would say, temporarily increase. Going forward, probably would be something that you saw in the previous quarters. But maybe here I still wanted to also add that in absolute terms, please do expect that the impairment expense will or might increase in the future, because we do focus on growing our net loan portfolio. As the net loan portfolio will grow, the impairment expense will follow.
And the last question from pre-submitted ones. So what equity ratio post dividends and what target dividend payout ratio should we expect at the end of this year?
So we should expect more than 20% of equity to total assets ratio post dividend payouts, and we will be targeting up to half the profits to be distributed in dividends. Again, more details will follow in upcoming few months.
Thank you. So next we will follow with the audio questions. I see that Frank has raised hand, so now you should be able to ask your question.
Absolutely. Good afternoon, Modestus and Maris. Thank you for the report. Two questions, and I'm not asking about the refinancing, by the way, for the first time. The number one question is, and I'm not sure I have the hypothesis in the right order, when the FX gets weak, the dollar gets weak. Let's stay with the dollar. If the dollar gets weaker to the euro, this time you argued that you had to absorb some costs on that. I always thought that the weaker dollar is good for the emerging markets where you're active in, like Africa, like Eastern Europe, etc., and you might get some benefits out of a cheaper dollar. If you can touch on that. And my second question, a very simple one. I saw that you have about 30 client contacts because before you conclude one trade in the car financing, so something like a 3% success rate. Would it not be a point where you might want to have a look at some of your competitors' portfolios, buy them up together with the clients, and spare yourself that hustle in finding the clients yourself, particularly if the market is as competitive as it appears, because only 1 out of 30 kind of closes with you? Thank you.
So thanks, Frank Oliver, for the question. I'll answer the first one. Probably we'll leave the second to Modestus. So the first question on the Forex. So actually, if you look at the emerging markets, actual current countries themselves, they probably do benefit from the cheaper USD. But as economies in whole, and you can actually, and we also see that as a business, that the markets where we operate, there's nothing wrong with the markets themselves. Of course, there's this global trade uncertainty. I think each market, each country is dealing with that separately with the US, which happens to be a major trading partner for almost every country in the globe. So, but nevertheless, the markets themselves, they are in good shape. If you look at our markets in Caucasus, we have not seen such low default or the delinquency rates as we have them currently. So they are at the historically lowest level. Economies themselves, they are in really good shape. However, where the painful part, weaker dollar comes in, it comes in through the fact that we need to reevaluate our business back into our reporting currency, which is euro. So all the, let's say, all the assets, all the net assets that we have in all the countries, which are kind of largely following dollar, now being revaluated back to euro, are, let's say, of a lesser value. So this is the impact that we see in our financials, in the profit and loss and balance sheet, essentially.
Okay.
Yeah, and in terms of second question, and hello, Frank. So in terms of buying competitors or competitor portfolios, of course, this is something which would be very logical, especially on vehicle finance side. And we're every now and then looking at potential opportunities in the market. But I guess we've already multiple times discussed that we actually don't have a very strong competitors with a significant portfolio. We have many smaller players. And sometimes it's to do a due diligence on a 5-7 million euros portfolio takes time, and it's not always logical to do it. So that's why we have not been too successful in finding such potential acquisitions or portfolio acquisitions. And as you mentioned, we have to raise this portfolio ourselves, but nonetheless, we are not disregarding that, and every now and then we're getting some interesting offers, at least to take a look at.
If you allow me one more question, and that is from your point of view, where you sit in, you have these 16 markets, and you're planning one or two more in 2025. Where do you see the best opportunities for this kind of lending, and is it in which regions would that be? Are we more looking into EU, Eastern Europe, or countries like Bulgaria, Romania? Are we more looking to Africa? Are we more looking into the consumer finance in some of these markets? What would be your one or two or three best markets you see the best potential in the next 6 to 12 months?
Sure. So first of all, I think overall consumer lending, I think, is going through rather good times across many markets. It's not only us. Multiple companies are showing strong results. We're managed to fight off banks competition in maybe European markets. There's plenty of new population to finance in African markets. So as an industry, I think it's doing well. For us, we tend maybe not to call out some market, but still, I'll do it this time. I think definitely Romania is one market which has been showing good potential, and I think it's a huge market where we're near to what we could be. Portfolio has really potential to grow there. Second, maybe not calling out specific market, but still adding consumer loans to vehicle finance markets. And here, biggest growth would come from Baltics, which we were, last 10 years, we've been purely focused only on car financing. And I think we've financed the majority of the population, which we could. Of course, they're changing their cars and so on, but we could not expect kind of high growth ratios. But once we're adding consumer loans to some of these customers. We see that that's an easy win, and definitely you will see growth coming from there. And on African side, still I would call out Kenya. I think it is a finance center. We've maybe had a bit painful experience there in the past in terms of not having fully hedged portfolios and so on, which is not the case anymore. We're very successful in local fundraising. Actually, most of the portfolio is already locally fundraised. And we've there we have multiple products. We have motorcycle financing, we have motorcycle leaseback products, we have car leaseback product, very successful, and we just launched mobile phone financing. So from all these, let's say, 4 product categories, we believe that we'll be able to grow quickly, but at the same time in a controlled way, kind of having multiple revenue streams, and at the same time securing financing pretty much locally. So these, I would say, 3 markets, 3 areas probably will see the most growth in upcoming 12 to 18 months.
Thank you very much, gentlemen, and happy summer and a very successful Q3, Q4, and so on. Speak soon. Bye-bye.
Very much.
Thank you.
Thank you. And now let's start with the questions that were submitted in writing during the webinar. So first question, Euribor now at around 2%, quite a steep down from 1 to 2 years ago. How that affects companies' results now, and what your insights in the future are if Euribor stays low or even gets lower?
So probably the development in Euribor and also central bank interest rates in general does positively affect our P&L. Maybe an important aspect to mention is that our debt is actually at the fixed rates. We don't have, or let's say we have a very small portion of floating rate debt, so which would have a direct Euribor impact, and that would have a decreasing effect already on the P&L. However, even with a fixed cost of debt, you can see let's say the strength of the credit markets in general. You can see that all reflected already in our bond prices, where the bonds are trading, the yields for both of the bonds. So generally, decreasing interest rate environment is of course positive for our business, and especially it is positive tailwind in situations where we are contemplating any debt refinance, as we already mentioned, 150 million euro bond. So this is positive tailwind for us.
The next question, what are the highest risks you see in your business? How much a possible economic slowdown would affect bad loans number? And how much, what percentage of loans issued are some kind of insured, for example, with real estate?
Sure. So talking about risks, very typical risk for any lending company. Of course, customer behavior worsening, some currency deviations. But if we think about our business, and the actions, what we've done lately, so in terms of customer behavior worsening, as of this moment, we don't see such trends. We don't see that there should be some red flags in any of the markets. Actually, economies are doing well, and I would say that we're in this still recovery mode because we had very elevated interest rate environment, which is going down, as Marius just mentioned. We also had still some COVID effects not so long time ago. And the Russia-Ukraine war had an effect. So all of that, we saw that our customers are able to absorb, economies are able to absorb, and they didn't have some significant effects to our business. So we feel that our business model is quite well prepared for some even one-off turbulent effects. And then similar station with this forex volatility, like in recent years, we've really strengthened our hedging capabilities, both raising funds locally as well as buying some hedge instruments. So I believe we're in as good position as we've ever been. And in terms of regulatory maybe risks, I do believe that in most of the markets where we operate, these regulatory changes have been done over the last 5 years, and then currently I would call this regulatory environment very stable, and we do not expect some unexpected new regulations coming in which could affect our business in a significant way. So overall, I would say rather calm period for non-bank lending as of this moment.
Thank you. The next question, what percentage of the profit are you planning to pay out as dividends this year? Should it be 2 half-year dividend payments?
So as mentioned before, we plan to distribute up to half of the profits in dividends. Going forward, we do plan to do that in 6 months increments, so 2 semi-annual payments. The next one to be done in the month of November. Still, please do remember that June dividend payout was an outlier essentially because we distributed half of the last year's full profit. And going forward, it will be done on 6 months increments, as already mentioned before.
Thank you. The next question, did vehicle finance portfolio drop by 5% year on year due to foreign exchange fluctuations?
Yes, that was the main reason for that, and I think we have in the slide which shows that if we look at local currencies, the portfolio actually went up.
Thank you. How did revenue increase slightly faster than loan portfolio when average loan yield slightly decreased?
Yeah, so I believe here there's a bit of a disconnect between the data to be compared because the revenue, we look at the revenue growth for the first 6 months of this year versus first 6 months of year 2024. So, and if we, but on the portfolio side, we're comparing the balance sheet figure portfolio end of June to the beginning of the year. So if we would compare that to the end of June year 2024, and just check the data, so our loan portfolio also grew by 10%. So if we compare like for like, there we don't see any disconnect in the revenue growth versus net loan portfolio growth.
Thank you. Why did company decrease equity total assets ratio? It affects negatively on return on equity in case when net interest margin minus cost of risk is larger than cost of debt.
So the decrease in the equity to all assets ratio was on already pre-communicated, pre-planned dividend distribution level. So this was the main contributing factor. You saw that in the previous slide when we had the equity movement bridge. So more than 80 million euros are in relation to the dividend payout. So that has been our commitment to the shareholders, which we have honored, and that's why we have publicly available dividend payout policy, which we are following.
Thank you. The next question, how much costs approximately could be added during possible issuance of Eurobonds this year? How much such issuance would cost as a financial service?
Yeah, so first of all, I would probably answer this question by saying that this is most likely a commercial secret. So our cost of debt that we are issuing, so I assume here we're talking about fees to the partners, not the actual coupon rate, which will be known only slightly before the deal will be announced. But in terms of the fees that we will be paying to our partners, yeah, that is something that we will not be able to disclose. But think about that this will be part of effective interest expenses. So you won't see that as a one-off hit in our P&L, with the exception of maybe previously deferred expenses from the previous issuance, which we will need to write off on an accelerated basis. But as it relates to the new bond issuance, so this will be part of total cost of borrowing for us.
Thank you. And now the last question we have received so far. So recently, the Latvian company Indexo announced that they are planning to buy Delfin Group shares. What impacts are you expecting on Eleving Group if the deal takes place?
Yeah, to be honest, probably no impact because neither we are competing with Indexo, neither we are competing with Delfin Group. We are present in Latvia, but still our customer base is slightly different, and still, as of this moment, biggest focus is on vehicle financing business, and I believe none of our companies is competing there. But we're a listed company in the same exchange as they are. So hopefully this positive news to the market and will attract even more investors. But from business perspective, it will not have any effect on our business.
Thank you. So now all questions are answered. Thank you for your active engagement and being with us today.
Okay, thank you very much, everyone. Thanks for finding the time to join the call, and thank you for insightful questions. Have a nice day and a nice upcoming week. Goodbye.
Sorry, we just received the last question. So what are your long-term target return on equity levels? What should we wait in terms of 12 months?
Yeah, so our long-term ROE level would be 30+%. So something that you saw already in the slides in the actuals. Please do expect that also going forward.
And one more question. So will US tariffs impact your company or its subsidiary?
So that's a good question. I think it will impact us to the same extent as it will impact every other country/company/person across the globe. So I think we're not in no shape or form immune to the global trade discussions, and we will roll with the punches, so to say. So I think our business is here. It has proven to be resilient through different challenging times, be it COVID, be it active war situations. So all that, our business has survived. So yeah, anything? I guess nothing to add from.
No, don't want to speculate on that.
Thank you. So now all questions are answered. Thank you for joining.
Okay, thank you once again. Goodbye, everyone.